Well, good morning. Welcome to, I guess this is about the second day of business finance. I'm not going to lecture much in this class, and frankly, this particular talk might be useful, might help you with the quiz that's due. Just to kind of give you a little background on finance. I'm going to go through it pretty quickly, um, and might help you. Chapter 2 may be similar, and then at the very end of the course, there's a couple chapters that may warrant a little bit of discussion. So take it as you will, and away we go. So originally, we had economics, and economics goes way back, right? The study of that goes a long time back. And the accounting side of things also goes back a long time, right? We got income statements, balance sheets, cash flows, etc. And we kind of got finance ending up linking those things together, and that became, as we'll find out, maybe a little bit more commonplace when um, we were able to do more calculations and more analysis because we had the technology to do that, be it even going back to adding machines, calculators, those types of things. So in the early 1900s, right, finance kind of emerged as a separate field, and in the 30s, getting into the Depression era, right, there was things about capital preservation and um, conserving our money, right, conserving our resources that we might need, because at that point in time, of course, everything was in a restructuring, and liquidity is much the same. Liquidity being basically the cash that you have on hand, or cash and equivalent that you have on hand, right? Reorganization and bankruptcy processes happened in the 30s, right? The 50s became more analytical again. By the 50s, we were starting to get more tools. Adding machines, calculators were becoming a little bit more commonplace, and so people were able to do a lot more analytical stuff, and did so, and it really advanced the field of finance, right? And we got into some, again, financial capital, and that is calculating what's the right thing to do. Should we buy capital items? Should we lease them? Different things like that became a lot more commonplace, and we could analyze those things, right? Before that, a lot of it was kind of done intuitively. And we got into cash and inventory management. Just-in-time inventory became a real deal. We're finding out now with the current supply chain crisis that maybe just-in-time inventory also has its limitations, right? Capital structure theory gets into should we finance our activities more with equity or more with debt? You might hear me say this often throughout the semester, and that, debt's always cheaper. Um, Is that going to change? Maybe. Taxes and those types of things can have a big impact on that. Actually, a reduction in tax rates makes debt a little more expensive, or maybe a little less attractive in terms of your capital structure, right? And then dividend policy, and I would add to dividend policy buybacks. Buybacks have become a huge thing, um, especially with bigger, very cash flow types of companies. Think Apple, think Microsoft. Some of those are engaged in some huge share buybacks. There you go. Evolution of the field of finance. Yeah, right there amongst Frankenstein and Dracula. So what are some modern issues? Risk return, right? That's just huge. Um, Something that we look at all the time, and risk always goes with return. Okay, so here, a little personal finance and business finance as well, and that is if somebody calls you up and promises you a 25% return, just run like hell, okay? Because that means that investment, whatever it may be, is risky, if not a scam, in fact, right? And so there's risk and return always go together. That doesn't mean that we don't take on some risks. Absolutely we do. If the returns may be high, it may be well worth doing that. But figuring out, which risks are worthwhile and whatnot, is a lot of that has to do with your financial management, CFO type of a person. The second part there is the same as the first, really. Portfolio management is what do we do then with maybe assets that we have on hand that make up our portfolio. In banking, ours was relatively short term and it was relatively easy because being an ag bank, during the growing season, we never had a portfolio. Okay, our money was all lent out to producers. During winter months, it was kind of the opposite. We might have a lot of cash sitting on the books, and what do we do with that? Well, obviously, we were going to lend it out again the next year, so we had to be relatively prudent. We had to keep it liquid so that we had access to it the next year. But other companies, if you look at Apple, the last time I looked at Apple, they had over $200 billion in cash and equivalents. What do you do with that? And they're buying back shares aggressively, and they're doing other things, but they're still generating so much cash. Can't spend it as fast as it's coming in, really. And then the capital structure, which we've already kind of talked about, right? Hedging has become, more widely used. Farmers and ranchers in this area are very familiar with hedging. A real simple hedging strategy would be selling your, on the futures, selling your 2022 crop early, right? That's technically a hedging strategy, right? And hedging became more commonplace in the real or other areas, I guess, other areas of commerce and business. Sometimes, and as we found out in the 2007 crisis, it got a little bit carried away with derivatives. What were the CMSs? Collateralized mortgage obligations, different things like that, some of which I don't even understand. Okay, I understand some basic hedging and whatnot, but you get into some of those other more complex instruments, and I don't even get it, right? And the truth is I think with any hedging strategy, if you're using it as a legitimate hedge, it can be a very good strategy. If you start speculating, and that's kind of what happened in 2007, 2009, through 2009, was we started getting a little too much in speculation. Inflation, you guys, have not grown up in the world of inflation. When I was going to college, and this will date me a little bit, but I worked in retail, and literally we would be changing prices. Inflation was so horrible. A good part of my job was just changing prices on inventory that we had on hand because the prices were going up that rapidly. I'd go in and I'd spend an hour a day just going around. Back in those days, you didn't have the prices on computers and whatnot that you could change easily. Every item had its own price tag on it, so we'd tear off the old price tags, and they made price tags so you could tear them off and then put a new one on there that was higher priced. We're getting back to that a little bit right now. The last year of inflation's been the worst in 40 years. 7% for a year. Wages grew at only, 4.5%? So even though wages grew pretty good, they didn't keep up with inflation. So wage earners technically went backward this past year. So some, significant factors. So what's the effect of that, inflation or deflation? And this gets where the economics kind of mixes with the accounting and gives you the finance. What do you do? Well, in general, borrowing money at the start of an inflationary period and rates are still extremely low, makes a lot of sense. You'll pay it back in the future with dollars that are worth less. That's two words in that case, not the worthless, but worth less in two words, right? What kind of rates of returns do you need, and what's your cost of capital, and how's all that affected by inflation? Again, usually, and using again a personal finance example maybe makes a lot of sense here. People that bought homes last year, right, and they were able to finance them at extremely low rates, anywhere from 2 to 3%. Okay, and all of a sudden those houses, the value of those houses are inflating. They're getting some wage increases, 4.5%, even though it's not keeping up with inflation. If they're not buying a new house, their payments staying the same. Okay, and so all of a sudden, while inflation's a big deal and house prices are going up, it doesn't affect that person on the housing side anyhow that bought their house last year or 2 years ago, and so it becomes a good deal, a good investment, and it's the same in the business world. There we go. Gasoline was up 50%, nearly 50%. I think it was 49.6% last year, which we all know as we went to the pump, the gas pump. But it's been higher than that in the past. So reasons for the 2007 through 2009 financial crisis, and again, you guys were kids, most of you, when that happened, and there's just some crazy unwarranted extension of credit. It just got carried away. Low doc or no doc loans, basically, and people could just say, yeah, I make $100,000 a year, and boom, they were able to buy a house, and for a while everything went well because we were in a time when housing prices were going up, and people were buying homes, and 6 months later they actually had some equity in it, and they might even sell it, flip it, but it all eventually caught up, and the house of cards fell in, right? Sale of mortgage-backed securities. We could go a whole semester on that, so I don't want to get too in depth in there. And here we go. We had credit default swaps, collateralized mortgage obligations, different derivatives, things like that. So yeah, government actions came in. The government was partly responsible for that. They'd created Fannie Mae and Freddie Mac, which created the mortgage-backed securities. Ultimately, out of that, we ended up with some new regulations. Dodd-Frank, I kind of call it Franken-Dodd. It really put the clamps down, and some of these were good, but some of them maybe a little bit carried away in terms of financial institutions. Made it more difficult for more consumers and mortgage people who want to buy houses. Made it even more difficult for them to do that. We often look at these as regulations and burdens upon the businesses, but those all filter down always to the consumer. So I won't, again, we could spend days, weeks talking about some of these new regulations that have come in. Part of what happened, with the financial crisis, too, is that banks got a little bit carried away and got involved in things that were outside of their normal banking, and that created a bit of a crisis. A typical bank, a traditional bank, right, gets deposits, lends those out to other people, makes a little bit of money on the difference, their net interest margin. But banks were getting in money deposits, and they were actually investing those in some different things. In this case, a lot of them were the collateralized mortgage obligations or the credit default swaps and some of those derivatives that all went to hell. The Volcker rule did come around, and that was probably a good rule. It limited the speculative investing by banks into those types of things. It set up the Bureau of Consumer Financial Protection. Again, nice things and probably very well intended, but also made things maybe a little bit more difficult in some ways. So now we got the internet, right? We got B2C, or business to consumer, and B2B. Believe it or not, we see as consumers, we see so much of that Amazon, Etsy, whatever. This is a bigger part of the internet, is the B2B, business to business. I think it still is. It's probably been a year or two since I've seen some stats on that, but I think it still is. So the B2C model, products bought with credit cards, but we're seeing that even change with some of the different fintech, financial technology companies, PayPal, those types of things, where your information is just out there on the internet, and you use that to buy it, right? And so it's getting to be less on credit cards and more with some other things. Probably why you're seeing probably more incentives and everything for people to get credit cards and use them. Cash back, those types of things. B2B models, again, very, very common. Lower the cost of managing inventory, and we're seeing go back to this because it's a whole different change. 2 years ago, I would have been singing the praises of just-in-time inventory and how wonderful that is and how much that saves companies. Now we've got this supply chain crunch, right? And stores are running out of things. We saw that early in the pandemic with toilet paper, but we're seeing it with other things as well right now. If you go to the store, there's shelves, certain areas that are empty. Some of that's because of hoarding, but a lot of that's just because of the supply chain crisis. just can't get delivered. I mean, it's my understanding that there's 400 or 500 container ships parked outside the LA port harbor. They just can't get unloaded. Can't get enough trucks, trains, and stuff in there to do it. So activities of financial management, right? Concerned with managing the entity's money. I would say assets, right, and liabilities, right, and capital structures. So allocate funds to current or fixed assets, right? We want a best financing alternative, short-term borrowing, long-term borrowing, those types of things. We may want to, right now the common belief is that rates are going to go up dramatically in the next year. Okay, if we could lock in rates, that would be a good deal, just like your mortgage, right? Locking in a rate right now for a 15 or 30-year mortgage might be wonderful versus a variable rate. Okay, now 15 years ago, if you'd have bought a house, a variable rate would have been a good thing. So, and they talk about dividend policy, and again, I'll say share buyback too. We're seeing that as much or more than we're seeing dividends actually. So, some daily things, right? Credit management, inventory, etc. Stock, bond, capital budgeting, dividend, and again share buybacks, and the trade-off between profitability and risk. And what do I mean by that? Well, let's say you could finance a business with 100% financing or debt. The bank would lend you 100%, and you made money that first year, second year, 5 years. Okay, what's your return? Your return on your investment's actually infinite, right? Because you didn't have to invest anything in that to begin with. And so your return kind of becomes infinite. That's pretty unlikely. Most banks or lending institutions are going to require equity. But the more you could borrow if you've got a good return, the higher your return on equity, which is ultimately, again, the shareholder value. That's what we're looking for. Okay. All these things, and we're going to talk about those. Form of organization, I'll kind of skip over here a little bit, although I would say that this is going to be kind of important for your project one, and probably the big thing here is that corporations are double taxed. Okay, C corporations are double taxed, S corporations are not. And that's going to be important for you in selecting your type of entity. Most of you are going to choose either a sole proprietorship or an LLC, probably, when we talk about that. So, excuse me, I had to sneeze. Okay. Corporations for small businesses, C corporations, are generally not the route people are going. There are farms and ranches that do C corporations, but that's because they're entitled to some different advantages that they have, tax advantages and whatnot. Okay, that again, another full semester we could spend talking about those things. LLCs have become very common because it limited liability. It can be taxed however you want. Typically, that's going to be taxed like a sole proprietorship or a partnership. Agency and we're not going to talk too much about that. Institutional investors have become more important, and what's that? That's mutual fund companies, Vanguard, Fidelity, those places, right? You and I, we might have a 401 through our work, and it goes through Vanguard. Hey, excuse me. Goes through Vanguard or Fidelity or one of those big institutional companies, right? And they accumulate all kinds of money, and in the process then invest that, and they become huge factors in the investment world. Sarbanes-Oxley, we won't spend a bunch of time talking about that. Again, that was some limitations. That goes back to a crisis that happened in, the early 2000s with Enron. Primary goal. The old thing was maximization of profit, and that's kind of changed a little bit. Because of these things, right? Change in profit we can have all kinds of new risk, and you'll see that sometimes even with public companies that, boy, their profit goes crazy for a year or two, and then you find out that, either they've been cooking the books or they've been engaging in some risky activities that fall apart. I don't know what happened in 2007 through 2009 with the banks, right? Because they made a lot of money leading up to that. Okay, but it didn't hold out. It didn't last because the house of cards fell in. Broader goal maximizing shareholder wealth. And here's an important thing, if you went back and you look at Amazon, up until 3, 4, 5 years ago, Amazon made zero money. Okay, maybe small, very very small profit. Even today, they don't show a huge profit, yet it's one of the biggest corporations by market cap in the world. Well, why is that? They've been reinvesting all their money, back into the company to build out the infrastructure and whatnot that they need. Okay, if you were an investor in Amazon, guess what? You've made a lot of money because the stock has, increased dramatically in value. So they've maximized shareholder wealth, but not maximized profits. So be a couple different things, right? Talk about shareholders. There's some new strategies coming out for investing. ESG is environmental, social, governance, something like that. I'm not sure how I feel about those things, and I don't know that from a basic standpoint they need to enter into our conversations that we'll have concerning finance. Valuation approach, okay? How earnings are valued by the investor. This is going to be kind of what we do in Project 2, right? We're going to take a look at these things, right? What's the risk? Are the earnings increasing? By how much? Are they going to grow over the years, et cetera, yeah. And so we're going to be judging financial managers maybe. This gets back into the social responsibility. We're probably not going to spend a lot of time on that. Insider trading is interesting. There's been some high-profile cases there. There's been some interesting mudslinging, or I wouldn't even call it mudslinging because it's truisms that have been cast at our Congress, because they have tended to, many of them, profit in the markets based on decisions that they make and are planning to make in their career as Congress people. And that's been in the news quite a bit lately. So congressmen are not prohibited from, congressmen and women are not prohibited from investing or making trades based on actions that they may or may not take. It's kind of an interesting thing, whereas people in the business world, if you're within a business, you certainly are held to a much higher standard, right, in terms of insider trading. So financial markets, what goes on in financial markets, and we'll study a lot of this as we go through, but it's interesting, and we live in a world now where this information is available to us in practically real time. It's great, it's online, anybody can access it, okay, and so the financial markets are a true, oftentimes, reflection of what's going on in terms of profits and those types of things, right? So you got public financial markets and corporate financial markets. Public markets would be bonds and whatnot, government institutions. Our government borrows a lot of money, and so we can buy bonds in that, as do smaller government entity, states, local types of things. And then you got corporate. There's domestic and international, of course, corporate and government. We kind of talked about that. Money and capital markets, again, gets back to, that's short-term versus long-term, basically. Money markets are short-term. Capital markets are long-term. Securities can include, common stock, preferred stock. Not a lot of preferred stock happens. We'll talk about that later in the semester. Corporate and government bonds are a huge, huge thing, right? I mean, our government, I think, owes $30 trillion or something like that. Add in corporate debt, you got a big number there, right? Primary market, right? That's when companies go out into the market to raise capital the first time, okay? Or even at a later date, but it's a new issue, okay? Be that a new issue of stock, or it could also be an issue of a bond. Secondary market is what you and I are more probably attuned to, and that's things like if we wanted to go buy some Microsoft stock right now, there's somebody out there that's a willing seller, we're a willing buyer. That's in the secondary market, though. That stock was issued by Microsoft 30 years ago, probably, maybe 40. Again, return and risk, we're going to talk a lot about that. And we'll look at some companies that, are raising money, that are new companies. I was listening to the financial news this morning. There's a company out called Fathom that's brand new. They're doing um, how do I want to call it, manufacturing in the new way, using more like 3D printers and those types of things. Kind of interesting. So restructuring, a lot of that's been happening with COVID and things shutting down, people having to change the way they do business, right? Going more online maybe versus bricks and mortar, those types of things. So a lot of that's happening, right? Can also include mergers and acquisitions, which quite a bit of that happens too. We're seeing more international, probably. It's possible in the last couple of years it's maybe moderated a little bit, but up until then there was a lot of international cash flow, right? Technology, right? Cost reduction in trading securities. Certain accounts that you might have with like Vanguard, Fidelity, depending on your account balance and stuff, Charles Schwab, you can trade for free. It's amazing, right? Years ago, buying and selling stocks was a very expensive ordeal, and so you typically bought one and held on to it because when you sold it, you were going to have to pay another fee, and it had to do pretty well in order for you to really profit, right? Yeah, we're seeing it in stock markets, brokerage firms been merging, electronic communications, electronic markets. So, we can probably buy and sell 24/7, depending on who we do business with. Those are all changes. So, quick look at Chapter 1. We'll, we won't have lectures for every chapter. Hardly at all throughout the semester, and maybe again until we get to the end. Thanks. Have a good day and good luck on the first quiz.